What is up, future rich bitches? So today we are going to talk about how you're losing money by saving. And I know this seems counterintuitive. I preach a lot about how important it is to have 6 months of expenses saved in a high yield savings account as an emergency fund. And I think that the pandemic has really shown us how important that is. I mean, if you look at the statistics of how many Americans actually have an adequate savings, it's like 23%. And in March, we saw some of the largest job losses in history. And so when we saw those staggering job losses, like 3/4 of those people had no savings to help them through this period of job loss. So since the savings is so important, then why am I telling you that you're losing money by saving? And I mean, don't worry, your balance hasn't gone down. You don't need to go check your account. But what's happening is that when we have inflation, it reduces the purchasing power of the money that you actually have in your savings. And that's because purchasing power is what you can actually buy with your money. So that means if you have $100 and you want to buy this awesome pair of shoes for $100, then you can do that. But inflation every year is about 2%. And that means that prices rise about 2% every year. So next year, those same shoes are going to cost you $102. So unless you make $2 more, then next year you can't buy those shoes. So they're the exact same. Nothing has changed. The only difference is that we've experienced inflation and those shoes now cost more. So this erosion of purchasing power because prices are going up is what is affecting the purchasing power of the money that you have in your savings. So your balance, once you hit 6 months of expenses, is staying the same. But inflation is happening at 2% every year. So you're losing purchasing power. Prices are going up and your balance is staying right there, the same. So you can't buy the same things that you could the year before with your savings. So I know you're probably thinking, well, this seems like a really stupid problem. Hasn't someone figured this out? Yes. Introducing the high interest savings account. So these things are just like amazing little creatures. And there's no catch. You just put your emergency fund in there and basically they just pay you more money to keep your money in them. So like Chase Bank offers about 0.01% for you to keep your money in a savings account with them. If you get a high interest savings account, I think right now they're a little bit under 1% just because interest rates are so low. But still that's like 0.99% if you're at 1% better returns that you're making on the money that you have in your high interest savings account. So that means if inflation is 2%, which means it's eroding your purchasing power 2% for the money in your savings, and you're receiving a 1% return in your high interest savings, you're only affected now by a 1% decrease in purchasing power with your savings. And so I know now you're thinking, well, that's really dumb. I'm still losing money. And yes, that's true. But this is only because interest rates right now have tanked. They're so low because the Federal Open Markets Committee, which decides where they want our interest rates to be, when the pandemic started in March, in the US anyway, they dramatically cut rates and what their target rate was for the federal funds rate. And they cut their target federal funds rate to 0%. And the federal funds rate is the rate that banks charge each other to borrow money to basically hold overnight and cover their reserve requirement. So a bank has a required amount of money that they need to keep in their vault at the nearest Federal Reserve bank every day. And that is their reserve requirement. So if it gets near the end of the day, you know, maybe Chase Bank calls up Citibank, new CEO girl girl power for Citibank. And it's like, hey, I can't meet my cash on hand reserve requirement tonight. Can you lend me some money? So then Citibank is like, yeah, sure, we can lend you this, and we're going to charge you the federal funds rate. Just like if you are charged an interest rate for borrowing money, same thing, except this is what banks charge each other. So the Fed actually doesn't set this rate, but what they do is they set the rate for the discount window, and that is the rate that you can actually, so like let's say Citibank says, no, we don't have any extra money, sorry about your luck. Chase can't find another bank to borrow from, then they'll go and borrow at the discount window, which is borrowing money directly from the Federal Reserve. So the Federal Reserve sets the rate for the discount window a little bit higher than what they want the target federal funds rate to be, or what their target federal funds rate is. And that incentivizes banks to set the federal funds rate slightly lower than the discount window, because banks want to make any money that they can from lending. So they're incentivized to have a lower rate because it's more attractive for a competitor bank to borrow money from them as opposed to the Federal Reserve. And then that way the bank will get any revenues from the interest that they're charging to the other bank for that. So if all the banks can get a better deal by borrowing from the Federal Reserve, then no banks are going to make money by shuffling this money around at night to hit their reserve requirements. So banks want that money and interest, so they set a slightly lower rate to become a more attractive option than borrowing at the discount window. So in March, when the Fed lowered the target federal funds rate to 0, they did that because this incentivizes, lowering interest rates incentivizes borrowing, which in turn incentivizes spending. And when there's a recession or the economy is expected to decline, the Fed wants money to keep flowing. They want people to keep spending. And so one way that they do that is by lowering interest rates to incentivize borrowing. Then people borrow money, they go spend it, it keeps the money flowing. And why this is super important is because like in times of recession, people tend to get cautious about the economy, so they will start saving more money and spending less money. And all that does is exacerbate the problem of a retracting economy, because if we all stop spending or are spending way less than we usually do, companies are making way less revenue than normal. So that means that if this hits, if it gets low enough, the company will have to cut expenses. How do they do that a lot of the times? They have layoffs. And when there are layoffs, that means now people, consumers, have less money to spend, so they spend less money, and then the companies again are receiving less revenue, so therefore they lay more people off, and it's a whole cycle. So the Fed does not want this to keep happening because it just gets worse and worse and worse. So they incentivize borrowing so that people keep spending money, and we can keep that money flowing in the economy to help rebuild as quickly as possible. So you've probably heard a lot recently about how, oh, if you want to buy a house, you should buy a house now. Rates are super low. So it is great that rates get really low for borrowing when the Fed cuts rates, but that also means that your rate that you're receiving from your high interest savings is also going to decline when rates decline. So that's because basically the bank who you have your savings with can't loan money at as high of a cost, and they can't make as much revenue with interest rates being higher, so they're not going to pay you as much to save with them. So that's why rates are so low right now, and you're only going to be able to minimize the damage of inflation on your purchasing power at this point. But later, once the economy is healthier, people are going back to work, they start spending more because they have more disposable income, because jobs are becoming more prevalent, then that will create a lot more spending in the economy, which will cause companies to raise prices because they're seeing a lot more demand, and then that creates inflation. So once inflation reaches above a target or about around the target that the Fed wants to see, which is typically around 2% every year, then they can raise interest rates. That will drop the demand for loans and borrowing, which will slow down spending and then slow down inflation. So while it does stink that you're still losing purchasing power with your savings, when the Fed decides to raise rates, once the economy is back to a healthy level, then you'll be able to receive a return that will compensate for all of your loss of purchasing power due to inflation. Or depending how high rates get, you may even be able to make a little bit of an excess return above that amount. Okay, so now that you kind of know how the Fed uses interest rates to handle economic fluctuations and how that actually directly impacts your wallet, let's talk about what's going to come up in next week's meeting with the Federal Open Markets Committee. So, bummer for you, they aren't expected to raise interest rates quite yet. They won't do that until they see a significant improvement in our economy, which probably will not be for at least a few more quarters, and that could be a couple of years. So with interest rates at zero, the Fed can't really lower them anymore. That's one of the best tools that they have to try to stimulate spending, which hasn't really worked with COVID because entire sectors of our market have been shut down because of we're trying to contain the spread. So like travel, service industry, restaurants, things like that have all been instructed to close. So even if you had money to spend in those and you were one of the lucky ones that didn't lose your job, you were restricted because of closures really to spend your money there. So interest rate lowering hasn't really had the exact same effect, and they're already at zero. So the Fed is now looking at some other tools that they can use to meet their goals. And their goals are to maximize employment while controlling inflation. And so what they've decided to do is focus on how they can maximize employment because so many people have lost their jobs right now. And what they're using to do that is inflation. So they want to raise the inflation rate to slightly above 2% and see an average of about a 2% inflation because we've been actually seeing inflation slightly below 2%. So when you combine the lower than 2% inflation with the slightly higher than 2% inflation they want to achieve, we should actually see about a 2% average inflation. So how are they doing that? So the stimulus checks that you might have received are one way. So they're putting money into the economy to spend. They're literally just giving people money. So this is a strategy called quantitative easing, which basically means that you just put money into circulation so that people spend it. And then again, we've already been through increased spending creates increased jobs, blah, 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 blah. So same principles apply using this strategy as with lowering interest rates. It's just a different tool that they can use to try to do that. So it'll be interesting to find out kind of what other things they're thinking about doing in the meeting this week. But, really the kind of crappy part about this is that an increase in inflation is only going to further erode your purchasing power of your savings right now. And since the Fed isn't expected to raise interest rates with this meeting or really anytime soon, that means that you'll still be getting a low rate and now actually experiencing higher purchasing power reductions than you were. So not that great, but if we can get the economy back in full swing quickly, then we can all benefit from that. And hopefully in these changes will do that, and then we will be able to see a bump in interest rates in the future. And again, once that happens, you will be able to preserve all of your purchasing power with your savings. And hopefully one day we'll see rates high enough again to make some money off of your savings. But for now, your savings is going to cost you. So I hope this helped. Still super important to have a high interest savings and an emergency fund. I will link below one of our articles on how you can set that up. And if you have any other economic questions or questions about saving or anything like that, make sure to comment below with those and to hit subscribe so you can take only 15 minutes a week every Saturday to build your financial literacy so that we can all become rich bitches. Thanks so much for watching. I'll see you next week.